Hello, everybody. This is ZS Caravella, and I'm back with another episode of ZKast, and I'm here with my co-host, Mark Reed Edwards. Say hello, everybody.
Hey there. How's everyone doing?
As is the case with every ZKast, this is done in conjunction with eWEEK, and so we're thrilled to be partnering with them on this. Mark, last week was AI week, and this week I think we're going to talk a lot about networking, so we'll call this Network Week.
A lot of stuff happening in the world of networks. And I guess we can start with Cisco expanding their SD-WAN.
Yeah, now, first of all, it makes sense. We're seeing a lot of innovation coming in networking just because the network has grown in importance, I say, since the pandemic started. In fact, I did a survey last year where I asked a bunch of business leaders, has their opinion of the network changed since the pandemic started, and 46% said, yes, indeed, the network's more important, right? It's the thing that connects to cloud resources, mobile, IoT, things like that. So now, one of the big shifts in networking has been this move from the WAN to SD-WAN. And Cisco recently announced a bunch of new products, 4 new boxes to its Catalyst Edge, its 8000 Edge family, and made it easier to upgrade from its older ISR, ASR products. Now, the Cat 8000 Edge router collection already had 3 models for SD-WAN, the 8500 for data center or colo, the 8300 for branch users, and they had a pure software-based 8000 for virtual environments. And it had a pretty advanced routing stack as well as some security features, so it can migrate to SASE. It added 4 new boxes to round out the offering. Of the 4 new models, there was an 8500L that was aimed at kind of an entry-level 1 gig, 10 gig aggregation use cases. There was other lower-end products, as well as one of the more interesting ones was a new branch offering, a 1RU Cat 8200 Series Edge Universal CPE, which is the product for a virtual and very lean branch. So I think one of the interesting aspects of what Cisco has now with their 7 different products is they have a block for almost any type of SD-WAN that you want. And a lot of the SD-WAN industry has pivoted, especially when you look at SASE, right? The Gartner definition, SASE being everything cloud delivered, which I think is limiting. Many of the competitors of Cisco have pure software platforms, or they're all cloud resident. And I think that makes sense in some cases for highly distributed organizations. Think of like, a big insurance company where you've got 1 or 2 people on every location. You don't need to be putting a big hardware platform in those locations. You can get those services from the cloud. But if you think of something like a big law firm where maybe you only have 10 offices around the world, but everyone's got 5,000 people in it, right? You still want your hardware resident. You're also connecting data centers, you're connecting edge locations. And so with a lot of Cisco's smaller competitors, I think they play off that expression of if all you have is a hammer in your toolkit, every problem looks like a nail. So what Cisco's brought, I think, is a tremendous amount of diversity to an SD-WAN portfolio to allow customers to really, kind of right size their deployment. And I think that's important for Cisco customers because they've got everybody from really small customers all the way to the biggest of the big, right? And so they're going to need boxes of different sizes. I think the other notable aspect of what they've done is they've made it easier to transition away from the older platforms to the newer platforms. So initially when Cisco came up with their SD-WAN product, you either had to run like a virtual partition on one of the older platforms, or you had to do a complete forklift upgrade. Now the transition path is much easier. And so I think what Cisco is really showing here is with their, being Cisco and being as big as they are, they're bringing, and routers is really what, started this company off. And I think they've just got a very broad line of SD-WAN products. And so some of the competitors might look at that and, say that it's all hardware based, and that's not the direction the industry is going. But in a lot of use cases, hardware still matters. And I think that's something that I've maintained a pretty steadfast opinion on. You can't do everything in software, right? It needs to run on something. And in some cases, when you look at what a router does, there are some features that are best optimized in hardware. There's some that are best optimized in silicon. There's some best done in software. You need a combination of those things to really get a good high-performing network.
Yeah, software is eating the world, but there's hardware behind it, right?
Yeah. I remember talking to one hedge fund manager who said that he had been talking to their IT people, and they said they have no hardware in their data center. And I'm like, I think you probably misunderstood. You might want to go check that and actually see. It's gotta run on something, and not everything runs well on general purpose hardware, right? You have to optimize some things in hardware, and so Cisco's been really good at that. I think the magic that they've created over the years is the understanding of how to make hardware, software, and silicon actually work together. Well, it gives them a good cost advantage too, because the ASIC versus CPU argument, you know, a high-end Intel processor is $2,000-3,000. You can, once you do ASICs in volume, you can spin them for $40, right? So $40-50, and so you do get a pretty good cost advantage. You can tailor the features specifically to that product. Fortinet does the same thing on the security side. They spin their own security silicon, and they get a very good cost advantage as well.
Yeah. We can talk about that hedge fund manager later when we talk about Reddit and see whether maybe he's still a hedge fund manager or he's managing a Denny's somewhere. But let's talk about Extreme Networks. They had their earnings call. What was your impression of that earnings call? One of two earnings calls we're going to cover today.
Yeah, Extreme is an interesting company. They have very quietly built a billion-dollar company. This was a company a few years ago that when Norman Rice and Ed Meyercord came in as the management team, people, I mean, I don't want to pick on it, but they were kind of a laughing stock. When I would ask IT people, did you look at Extreme? And they'd either laugh at me or say, I thought they wanted a business, right? And, but they've had a very nice run. A year ago, actually back in March, the stock was trading at about $3, and I think now it's around $11 or something like that. Based off this earnings call, they actually pre-announced numbers that they were going to come in ahead of numbers this quarter. Revenues are up, profits are up, and this is a company that I think is highly misunderstood in the industry. They're almost $1 billion company, making them the largest enterprise network pure play. Right, Cisco's highly diverse, so is Juniper and things like that. But all Extreme does is focus on enterprise. And the company that exists today is a roll-up of Extreme, Enterasys, Avaya's networking business, Aerohive, Motorola's Wi-Fi business, and Brocade's data center business. And when they initially put that company together, the stock did shoot up and then it fell. And I think the work to integrate those products together was really pretty onerous, and customers had to migrate platforms. What's been driving the stock, though, and what's been driving revenues for the company has been what's called their universal hardware platform. And again, here we are talking about hardware in a world where the software is eating the world. And the universal hardware product is actually really, really cool. And there's a lot of companies now that give you software freedom, where you can have one hardware base and swap software out on top of it, right? So depending on the workload you want to run, you can do that in virtual machines or whatever. Extreme does the opposite as well. So they have that, but you can keep your software and then swap the hardware out underneath it. And so if your needs change, or you need more performance, or you want to just take that product and put it to, in another area, whatever, you can mix and match the different hardware platforms. And so they've decoupled their hardware and software. And so you can have one software image and have a lot of options of hardware, or you can have the same hardware and have options of software. And that flexibility, I think, has been something that their customers have really liked, because it lets them, when you think about having to buy hardware, Mark, it's a tough thing for IT people, network managers, to think about, because I either buy what I need today, and then I know I'm going to run out of capacity in a year, or I overbuy today, and then I run underutilized for a year or two before it finally catches up. Now I can buy what I need today, but then migrate upwards when I need to without disrupting my business. And I think that agility, I think, is at the hardware level, is something that's really unique to them, and something that I think we should be looking for. This is a company, I think, that's finally got all the piece parts together from all the companies they've acquired. And I think we're going to see them continue to grow. And I think they're they are a formidable company. They're in the Gartner leader quadrant in the segments they play in. So it's been a good run for them. Having come from this little tiny company that most people thought were going out of business to legitimate billion-dollar company.
Yeah, and it's funny when you mentioned the list of companies that they had acquired. Within those companies, there's a bunch of acquisitions that I remember from 10, 15 years ago.
Yeah, their CEO Ed Meyercord has the slide that he shows where Brocade was also part of Foundry, Avaya Networking had Nortel in it, Cabletron was part of that as well. And so this, in some ways, this is when you look back, if you go to the Wayback Machine and you type networking in, you would get a lot of these companies in there. So it's been a pretty fascinating roll up. And I'll tell you something, their COO, Norman Rice, he is a guy that you do not want to negotiate with. I've heard this guy will, negotiate you down to your bones. So he's gotten some, the deals he's gotten on some of these companies he's bought has been phenomenal. And I think from a shareholder perspective, that's good news. And certainly from a customer perspective, this is a company now that's, I think, really primed.
So how about Juniper? Juniper had their earnings call. That's a venerable name that we all know. And what's going on with Juniper these days?
Yeah, Juniper is interesting as well. The company did announce that they had a slight beat on revenue and profitability from the quarter. The networking, they posted revenues of about $1.2 billion, which is up slightly, and about 1% from a year ago. But it was ahead of their own projection of 1.19 billion, so they had a small increase. Their profits were 55 cents a share, so 2 cents better than they guided. And if you look, they have three main businesses: routing, switching, and security. So routing was up about 10%, but then switching and security were in decline. I think what was notable, though, is when you look at the segments that they play in, cloud revenue was up fractionally, service provider revenue slipped a little bit, but then enterprise revenue was up 7%, which is huge for that company, because this is a company that has always kind of ebbed and flowed along service provider cycles. And certainly service provider spending is down right now. Who knows when that's going to come back? Seeing them play in cloud is good as well, so that was up marginally. But the growth in enterprise business is important because that can help stabilize the business through the service provider ebbs and flows. And I think in the enterprise space, they made an acquisition last year of a company called Mist Systems, which I think when we look back in time is going to be one of those really key acquisitions that companies make that sets them on the right path. So Mist, for those who don't know it, is an AI company. Really, you can think of them as a Wi-Fi company, but they're really an AI Wi-Fi company, and they do a lot of. In fact, they have a product they call Marvis, which is a play off Jarvis, obviously, so Miss Jarvis, that you can ask it questions on why isn't Microsoft Teams working? Why isn't this application working? And it'll tell you and give you reasons why. So Mist was an AI engine that was built for Wi-Fi. Since Juniper bought it, they've now applied it to the SD-WAN, they've applied it to the campus, they've applied it to the data center. And I think that's one of the reasons why you saw their enterprise revenues up. And so I've always looked at Juniper as kind of the other guy in enterprise, that kind of a high performance alternative maybe, but a company that really could never get their act together in the enterprise space. But I think the addition of Mist is really the catalyst they were looking for to that AI engine is the thing that can bring all those components together. And since then, they actually bought a company called 128 Technologies, which gets them a better SD-WAN product, and then a company called Apstra, which is an intent-based networking product for data centers. So they've assembled a nice portfolio, and I would certainly expect to see that enterprise piece continue to grow.
128 Technologies sounds like a company from the 1980s in Waltham,
Yeah, well, they were on 128, and it's funny because the founders of 128 Technologies, their last company had just as boring a nondescript name called Acme Packet, and so I suppose the Coyote went and bought those kind of things. But for whatever reason, Andy Ori, the guy who started those companies up, likes these generic names that nobody knows what they do. So, yeah.
All right. So DriveNets.
So DriveNets is an Israeli startup, and they just announced a $208 million round of funding for Series B that brings them to unicorn status. So congratulations to the folks at DriveNet. You're a $1 billion company. DriveNet, last week I actually did the Fierce Telecom event, and I did a panel on disaggregation, and DriveNets was one of the panelists. And although I was doing the panel, I can tell you my opinion of disaggregation historically has been disaggregation, schmisaggregation, right? It's just like this thing that we talk about, but it's never really caught hold until recently. And I think DriveNets has really mastered the art of disaggregation. Now, I will say disaggregation is a little bit like cloud, where every vendor has their own definition. So if you think back, Mark, to when we were at Yankee Group, people call hosted services cloud, right? It wasn't cloud. That was just running a legacy workload somewhere else.
Right.
But we called it cloud. And similarly in the disaggregation space, there are companies that have decoupled the sale of hardware and software, and they call it disaggregation. That's not disaggregation. That's selling you the same stuff, just with a different revenue model. So you think it's disaggregation, but you still need their software and their hardware. What DriveNets has made, and there have been companies that have tried to build a pure software stack to run on networking, but it's never really worked because performance has been a problem, right? So networking isn't easy. Well, networking is easy to do at low speeds. If you want to put up a network in your home and watch Netflix, yeah, that's anybody can build a kind of a plain old white box to do that. But if you're going to do it at service provider scale, right, that's hard. And DriveNets is the first company to really figure that out. And I talked to them about it at the Fierce Telecom event about what makes them different. Why do they get such good performance? For instance, AT&T is one of their major customers, when other people haven't. And they said they realized that if they're going to use, they can't use just off-the-shelf Intel processors. That doesn't have the horsepower to do a lot of the network forwarding and things that they need. So they do use Intel for some aspects, but then they also complement it with Broadcom silicon. So the same silicon that like an Arista uses or something to build these high performance data center products, or Facebook uses to build their products, they now use in there. So they use network processors with highly optimized software and complemented with CPUs, where in the past everybody's tried to do it just on x86 platforms. And I've always said about Intel, if you want a processor to run Word, hey, use Intel. If you want to do anything advanced, then you got to go to another silicon manufacturer, and that's where Broadcom and Cavium and companies like that have really done a good job. And so I think from a DriveNets perspective, they're the first startup that's really mastered the art of disaggregation, and I suspect you'll probably see them become an acquisition target. I think they've legitimized their model.
Someone will aggregate them.
Yeah, yeah, and and someone should. I think they're a good. I know somebody that works there, and when I was talking to her about it, I kind of rolled my eyes at first because I've heard this story before. But to be honest, and this company does it right, and they've got a platform that really scales. And a lot of the performance problems that we've seen historically from open source and other types of white boxes, they don't suffer because they've done a good job of marrying the underlying silicon, but with a highly agile software platform.
So you mentioned a hedge fund manager earlier, and there's something in the news that we see every day, and we're seeing this Reddit GameStop stream of news, and it's really individual investors, day traders versus hedge fund managers. And it's using Reddit, and it's using networking in the kind of broad sense as the way to spread, the word on a stock. What's your overall impression on this?
Yeah, it's a fascinating. It's been fascinating to watch because I'm obviously a hobby investor myself. I've got my own TD Ameritrade account that I play in all the time, and I do pretty well with some of the stocks I bought. Although in full disclosure, I do follow Kramer's advice sometimes, not the one from Seinfeld. The Reddit phenomenon is fascinating because it's a bunch of, if you're familiar with the expression, somebody described it this way: it's a bunch of hedge fund managers being pantsed by a bunch of millennials, right? That are on Reddit that are causing these fund managers to have to cover their short positions with overly inflated prices. Now, in no way is GameStop worth $25 billion, right? I mean, this is a company. This stock's going to fall sometime soon. but it does show you the power of social, the power of the internet. I mean, a lot of the civil unrest that happened in Egypt was organized. Remember, a few years ago, was organized through the internet, right? And so Reddit is doing exactly the same thing. In fact, this is something that societally we should think about. I mean, much of what happened at the Capitol, right? That was organized on social media and Facebook. And so this is a similar phenomenon where a bunch of people got together in that Wall Street Bets channel, and they saw an opportunity where a bunch of hedge fund managers had shorted the stock. AMC was another one, and then they forced that price up, causing those fund managers have to cover their short positions and squeeze them. And the stocks went up and down and up and down, and it's caused all kinds of problems. Right? Robinhood suspended trading for a while. They brought that back. There was one government official in Boston that wanted to halt trading on these stocks for 30 days. We've seen the stock markets halt trading for short periods of time, and I don't think anybody has any idea what to do with the Reddit buyer now. But clearly, there's enough people following that to move stocks, not just a little bit, I mean, up and down enormously. And in some ways, it's taken the power away from a lot of these fund managers and moved it, to a broader group of people. So it's, I don't know if it's good or bad. It's been fun to watch. Ultimately, it's probably bad because we're overly inflating stocks that really have no, why is there even a GameStop in existence? I mean, that's one of my kids works there, and he said most of what they sell now are, Star Wars Legos and things like that, and action figures and comic books and stuff. Most of the games are bought online now. So, but it's a fascinating scenario to watch, and the up and down. And I thought about shorting the stock myself after the first day, but then it doubled since then. And so I'm glad I didn't. But it's brought a level of unpredictability to the stock market that we haven't seen perhaps since the year 2000, right?
Yeah, but it's kind of funny because it's kind of the disruptors have been disrupted, right? So hedge funds, they kind of have held the control panel for all this, and it kind of got ripped away by these Redditors.
That's true. And I think just from a volume perspective, it shows you that a whole bunch of small investors purchasing has actually greater purchase power than all the fund managers out there that were looking at that, right? So, but clearly the buying here isn't based, it's based on mania, not fundamentals. And I think ultimately that's a bad thing. Yeah, I'm certainly not buying at $300 a share. So I'm not Series 7 licensed, and I'm not allowed to make stock calls officially. But if you're thinking of buying GameStop at $300 a share, don't. All right. Well, I think that wraps things up on Network Week here, Mark. So thanks for joining me again, Mark. And I want to thank everybody for watching us. And if you're watching this on eWEEK, I'll sign off like I normally do there. Have a great rest of your eWEEK. And thanks for watching. And don't forget to click to subscribe.